Hey, what's up, Ricky? How are you? Can you hear me?
Yeah, how are you?
Good, good, good. Hey, sorry, I'm in a computer. I don't have my it's a shop computer. I don't have a camera on this one. Um, yep. Can you hear me?
Yeah.
Oh, okay. Sorry about that.
Um, Good to hear from you. How are things going, Khaled?
It's good, good. So far, so good. Firing on all cylinders. We got work coming in on the regular sign business, and the Airbnb is still going good. And yeah, and my mom's house, thanks to you, it's running smooth too. So can't wait, man.
Oh, yeah. Trust me, I'm excited because it's different when this is a new scenario for me where there's no agent because a lot of times the agent does a lot of the work that they're supposed to be doing, obviously.
Hmm.
But since there's no agent, then you and I had to do some of that extra work,
Hmm.
and so some of the responsibilities um, that were new to me. But it's all good because I learned, and now now we're ready for the next one, right?
Yeah, yeah, that's crazy, man. Man, I don't think we've never had. No one in my family has ever had like a brand new house like that. It's my mom is super happy. I guess I'm kind of not as emotional because it I kind of see it as an investment. I try not to get too attached to it because what if something happens or whatever. But as it's getting closer and closer, I'm like, dude, it's gonna be time to celebrate soon. Like, yeah, I guess I'm protecting myself, but yeah, it's I look back and I'm like, that's a brand new house. Like, there's not gonna be bills, there's not gonna be repairs, and that's we're pretty lucky, man. A lot of people were fighting over for old houses that are gonna have to replace the water heater like in a couple months or in a few years. So yeah, man, it's really cool.
Yeah. Well, again, I don't think things happen by accident. I think that everything that all the steps that you took towards buying a home led you there,
Yeah,
um, and that's the bottom line, you know. So
actually, yeah, you bring up a good point. That was ever since I broke up with Eric, I've been having a lot of time to get back to the things and stuff that I was doing before, and one of it was the law of attraction. And I remember Bob Proctor. You remember Bob Proctor? He was one of the old guy from The Secret.
yeah,
Yeah, yeah. So he had a seminar called Born Rich that was filmed in the 70s. And the full seminar is there. It's like 6 parts. I think it's like, yeah, it's over 7 hours. But the guy breaks down the law of attraction like no one, like in a very specific, non subjective terms. And I remember, like, I printed the binder, I went through the exercises, but I must have been young. And I remember it did have an impact on me. But I guess the repetition and being in the wrong environment kind of pulled me back. So for whatever reason, I started rewatching it last night, and there was one part. Uh, I'll send you the link, but I was like, "Whoa!" I do not remember seeing this that first time, and he was talking about how um, the that sometimes like the people that attract things really quickly, it's because they're working at a higher state of consciousness, right? But on the opposite spectrum, you have people that they're basically just more aware. The ones that manifest things very quickly without a problem, they live very nice lives. But on the other side, he says what there is ignorance. But he meant more like they just don't really understand how the law of attraction works, how um, this consciousness thing works. And he basically makes the connection that vibration is consciousness. So there's different degrees, and people that are making only, let's say, like, $30,000 a year, it's not because they want to, it's because they're not aware of how to make more. So it's all a game about awareness. And he talks about how when we don't understand um, how to protect our mind, our subconscious mind, from outside influences, the end result ends up being fear and worry. And now to bring it all full circle, the reason why I'm telling you this is because throughout the process, I think at the beginning, I just became conscious that even though I have really good ideas and good intentions and I know where I want to go and I know what I want, what I wasn't aware of is that I a lot of times let fear and worry cripple me and set me back. But like what when you watch the video, I think it's only like 20 minutes that portion, but it really clicked onto me. I think that's my biggest blind spot. That the whole thing about the law of attraction is about emotion and sensations and feelings, and the whole point of the boards and the vision boards is so that when you see that vision board, it triggers that positive feeling. But what I'm noticing now is that a lot of times or throughout the day, I may want something, I may be in pursuit of it, but then I let outside influences change my vibration, so I start feeling worry and fear without noting. um, so now that I know, anyways, I'll just leave it there. But it's just you when you mentioned that it's a process. I'm like, yeah, you're right, because I've noticed that my mom, even though she doesn't have all the technical information, she has a lot of faith, and she has a lot of um, like, it's weird because I'm kind of doing the work for her, but she just taught me something. She's like, no, mijo, it's like, it's just, you just need to believe. And I'm like, you know what? I guess in the past I would have said no, it's more complicated than that, but it isn't. It really isn't. It's actually like she had it right. Like the right people will come. So I almost feel like I'm assisting her, but it's her. Like she attracted it, and I was just facilitating it. But it's been a super trippy experience. I'll send you that video because I think that's by far like the most important thing and that I've learned just recently. And it sucks because I just learned that he died. He passed away on February the 3rd last month. And he would always talk about, in that seminar, he would bring out like a sand clock, and he would say, it's like, if you represent this someone's life, like we never know how much sand someone has. Like we may think like they're gonna be here, for until they're 70 or 80, but they're actually might be gone. And I was like, shit, it really hit me now. It's like, damn, I really don't know. But yeah. Anyways, I'll send you that link, man.
I think I don't know if I was typing I was typing when you said I wish I knew sooner, and I was typing something that said I'm just gonna tell him, and you just reminded me again that that's why the present is such an important thing. Just being present and saying thank you, and like me, thank you for one, being my friend. And I've also learned a lot from you, more on the people aspect. I think that knowledge in terms of like technicalities, how to do a deal, how to buy a home. Those are, I call them technicalities because the info is out there. It's out there. It's just a matter of finding it. But learning to deal with people, there's no manual to deal with people. Everyone's different, and while uh, there's information like the one you experienced recently, like the different personality types and the attachment theories. It is based on information, but it's also it's almost like, and I'm gonna use this statement to make a point. Almost like we're trying to play God to determine or figure people out. But how could you really? I'm not saying that I cannot get to know you or I cannot get to know my spouse, because I think it's possible. The more you deal with somebody, the more you get to know them. But I think it's also embracing their uniqueness and realizing that they're always changing and evolving, and it's like a variable, right? It's like you're not always the same person. You're always growing. You're always learning different things from your exposure to different information. So why should I treat you the same, or why should I know supposedly, or that I know how to treat you or who you are? If you're a constant changing being. And I say that because that's how I see you. You're always growing, learning, changing, and it also makes me want to change, grow, because I want to get along with you. I want to add value, but I cannot add value being in the same spot that I was when we met, 10 years ago. So I also
Hmm.
have to evolve, and I think that's the value that I gain from interacting with someone like you. Uh, because and it's cool, and it's cool to grow, and just imagine what we're gonna be in the next 10 years. We're probably gonna be in the Caribbean islands or something. We're like, oh, we're out
Mm, it's
And
crazy.
just helping others. I think it's all about contribution, being able to help others. Um, yeah, I think when you sometimes people say, "What's the purpose of life?" And I said, the purpose of life is to be contribution, to be something for someone or somewhere. And that could be being a mom, that could be being a dad, that could be being an investor, that could be being uh, just a bystander to say thank you, to say, like we can all be in contribution. And when you find that as part of the purpose of why we're here, then I think it makes life much simpler and much more fun because it's not about like, what am I gonna get, but what can I give? Um, but anyway, that's my 2 cents on what you said. So response.
No, thank you, man. I appreciate it.
Yeah. So ready to go over this info or what?
Yeah, for sure.
Okay. Let me see. Where's my screen? What am I sharing? I gotta learn. I know you sent me the video. What do you see right now?
The spreadsheet.
Okay, you don't see this. Okay, let me see. Let me click here. Uh, okay, spreadsheet. Oh, there we go. New share. Share. Okay, what do you see now?
The schedulee.
Okay, got it. So you know how you have your. I'm gonna go back to the basics and then I'm gonna answer the DTI.
Mhm.
Um, so first the Schedule E. The Schedule E here, this 74,000 is your rents received. This is based on all this information you gave to Fernando.
Mhm.
Then what he's doing, and you already know this, just to recap, based on like some info, like interest paid, it's already set in stone. Like you cannot change that, right? Because it comes from the 1098 or 1099 that you get from the bank. It's already set. That's that you have to report. Period. I mean, you don't have to report it because clearly your last tax guy missed that portion or one of them.
Mhm.
But my point is that those figures cannot change. They're already set.
Mhm.
So, for example, insurance is set. Mortgage interest is set. Let's see what's set. Taxes are set, because they come from the county. Figures that are not set are like, I guess, potential utilities are set or depreciation, uh, but they can be adjusted depending on which tax accounting methodology you use. For example, I know we talked about depreciation. So I bring that up because I guess it'll be up to you and Fernando. And I asked them the question, like, can we? And this is also I'm curious myself. Can we recategorize some utilities, maybe more personal? Because I get that you spent 13,000 on gas, electricity, for the purpose of the Airbnb, but what if you live in the property for a month or 2 months? Then I'm not the tax expert. I'm just curious. Does that mean that I use them for personal use rather than business? And if so, as a consumer, do I have the choice of whether I report 13,000 as utilities or 11,000 because maybe 2,000 of that 13,000 was consumed by me and therefore it was not a business expense? Not sure. I'm just kind of thinking aloud, right?
Mhm.
And I bring those questions because uh, uh, rents received and then we add back some expenses, but those expenses that we add back are also impacted by your total expenses. And so, I guess let me pause there. I want to make sure that you're tracking what I've said so far.
Mhm.
Make sense so far a little bit?
Yeah. Yep.
Okay, now, so just kind of high level review, right, of what I said. Now let me use the schedule. Let me use what is the form? I think it's this one. Share or not? Share, new share. Where's my phone? Hold on. Okay, 1 second. no, I did have it. It changes so quickly that I guess my site cannot keep up with how fast those.
Makes the changes.
Okay, what do you see right now?
The schedule E, and you have highlighted that 74,000,
Okay, so let me
line 3.
add it. Now you see something else, right?
Yes.
So this is what the underwriters use, and here's the thing. This is more like my job, right? I know you're very, learning. I call you very detailed. Like I said, and by the way, I think when I say I know, when I say things like, "Oh, your brain, it has to make sense to your brain." What I mean with that is that, again, we all are different. Like for me, I don't need to know every detail. I'm more like Henry Ford. I just need to know the people who know those details, and as long as I can ask them to do it, then I'm good. But everybody's different, right? So I think you and I discussed once Robert Kiyosaki and his concept of hiring professionals, hire CPAs and attorneys, and you compensate them well because they are the subject matter experts and do a good job. Like you never want to shortchange your experts because then they're going to shortchange your financial situation. And I remember we talked about this like 10 years ago or so. So that's always stayed with me. And now I'm in a position where I am becoming the expert, right, on loans and all that. And I said becoming because I don't think we ever arrive, especially in this industry, because it's always changing. Guidelines changing literally by the week, by the month. Rules change because some of them are government related, some of them are lender related, some of them are credit, impacted. So there's always changing, and for you to keep up with that, it's hard. And unless it's a full time job, by the time you learn something, it probably already changed. So you have to either be constantly plugged into a loan officer like you are doing now,
Yeah.
or plugged into your investment group because I would imagine there are some kind of information being given that is up to date. So I say this to say the following. I know we went over this, and you don't remember, or maybe you do, but I remember because we covered that. But because this is something you do every day, to me it's common sense. But for you, it's going to take you a few times to know it. But even if you have this tool, I guess you will have time. You will have to make time to kind of break that, to use it, or you can just ask me to help you. But it's up to you. So anyway, with that said, this form that we're looking at, it's you can cross-reference this form. This is form on the Fannie Mae, Freddie Mac guidelines. This is something that's available to everyone. You just have to know how to find it. Not just for loan officers, but consumers, loan officers, managers, you name it. This is the same form that underwriters use to calculate income from investment properties that are reported on Schedule E. So again, your Schedule E, it shows 74,545. Here it is. All I have to do is follow this tool, letter A1, A2, A3, and literally answer the questions. But these expenses here that are on this form, they don't, they're not all exactly the same as on the Schedule E. Only some of them. Why? Because we are concerned about the income that gets added back to your rents. We're not concerned about other expenses. That's like utilities. Like I'm using that as an example. That's between you and your tax person. Now, when I use that Schedule E that Fernando provided, look at it, we're still in the negative. What does that mean? This means that your property, yeah, it's you generated 74,545, but once you report expenses, tax, yada yada yada, you're in the negative per lending guidelines. Per lending guidelines. Granted, you might have 10 grand saved up from that, but based on numbers, this property it's costing you, or it represents an $870 liability on a monthly basis. Now, what you want to do is be at zero or positive. At the minimum at zero. So why zero? Because when you're at zero, then we don't have to worry about this property as a variable to calculating your debt to income ratio. Because if this is zero, it simply means that when you're thinking about buying another property, this property has zero negative impact on your income. But when it has a negative impact in your income like it is now, then it's another variable that we have to account for, and it gets complicated, and it messes loan officers and underwriters and everyone, because it's just one more variable to consider. And I can tell you how in a moment, but I wanted to just pause here again, and want to make sure that you take in the input that I said and what questions you have so far.
Yeah, okay. I think that was probably my biggest source of confusion right there. I was under the impression that perhaps that bottom number needed to be what amount to a bigger number, and that would be somehow what I like what I would be able to afford. But I see that it's not. Basically, you just need to check that that property is not a liability, that it's not
Got it.
affecting my negative. It's not like a $200, the equivalent of a $200 payment out of my income, right? It, or like a whatever payment. That's why if it's zero, it's still good because it's
Yeah,
not
if it's
affecting me.
zero, still good. Now, I checked out the Dropbox that you share with us.
Uh huh.
Um, I didn't see a recent statement. I think the most recent was from last year. But what's your? I think they removed your mortgage insurance, correct?
Not yet. I've been. I think they're gonna take probably like a couple of months to do it.
Okay. Well, because this year the 2477, it's supposed to represent your total PITI
Hmm.
plus mortgage insurance. PITIM.
Hmm. So yeah, see if with that number brings down, it'll help too, right?
Yeah. So let's change it. So 20. Let's say it's 160. Let's say 2310. 2310. So now, if I change it to 2310, then your property now represents a 650 monthly liability, uh, based on the numbers that the way you have it now with Fernando.
Hmm. Gotcha. Yeah. No, I think I totally agree with you that this is so complicated and it can change. So it's just better to have someone that's fully specialized in that overview it. What I'm trying to do mainly is just understand things at a basic level where I understand how it works and the parts that don't change, which is what you just told me, like that it needs to be at zero, just so that one, I can talk to people, understand what they're talking to me, talk to the accountant, talk to the lender, but also kind of strategize. Because to be honest, I think I've just been kind of bumping my way through, but I've never. My one of my goals is like now that I'm understanding the numbers of the business, like sit down with someone every month, check the numbers, have a like a 4 month strategy, a yearly strategy, and then. But it's just difficult if it's not if it, like if you guys were all working with me like right here in the same office and we were all part of the same team, I could see that happening. But when it's all segmented, it's hard for those parts to communicate, and I think they communicate through me. But this is so complex that even for me, I have this thing called monday.com. It's like a project management thing, and all the information, and now I'm dumping it in there, so now I can come back and actually like left off where I pick up where I left off, and now things are beginning to make sense. But prior to that, I think I was uh just bumping my way through, and I didn't want to ask. But yeah, uh so then how does this I remember last time on your email you said that there was a number. I think it was like 10,000. um how did you come up with that number? Or
Okay, you got it. So let me put this back to where it was. You're seeing me changing the numbers, right?
yeah. Hmm.
Okay. So when you look at your Schedule E form, total expenses are showing at 92,506.
Hmm.
And so look at what happens if we just literally change that number from 92 to 82. Look at
Okay,
this
it goes to
bottom now.
positive. Hmm.
Now your property represents like it's making you $16 of income a month.
Uh-huh.
So that means that the loan, you know how you have a monthly payment of 2477.
Yeah.
this after we do this calculation, it means that you're generating enough money uh, that it's actually cash flowing $16, which means that it's a great thing. That means that you have a loan of 24.77 a month, but it actually have a positive cash flow of $16. So the loan is being covered along with all your other expenses. And this is what the underwriters use to ask themselves: does this property that Khaled has, that, is it costing him or is it helping him? So again, let me change this back to 92,000, which is what you guys have. So you're in the negative. Now, for me, I already told you, so let me highlight this one. So, yeah, so all you have to do is, let me see if I can control, what does this one control? Okay, let me just talk it out.
Mhm.
If you have two screens, or if you're looking at your schedule E, hold on, let me take it. Yeah. Okay, so look at this, 92,000, right?
Uh-huh.
You see here, 92,506. We already know that this expenses here, they like insurance expense, it cannot be changed. It's already set. Mortgage interest is already set. Tax expense is already set. Depreciation, maybe you can change it depending on which tax method, depreciation method you want to use.
Mhm.
That's about the only one that can change out of the items that get added back for purposes of giving you credit.
Mhm.
So that means that when we look at your schedule E, which I'm gonna go there now, share schedule E. Where are you? This one. Let's see. Schedule E. Uh-huh. Okay, you should look at your schedule E, right?
Mhm.
So again, taxes we're gonna change, mortgage interest we're gonna change, insurance we're gonna change. So then you have to, if you want to break even on the other form that we were just looking at now,
Mhm.
I'm not even looking at this negative 17,000. That's just confusing.
Mhm.
I'm looking. Remember, I use the total expenses.
Mhm.
So if we need to change it by 10,000, but certain items cannot change, like taxes cannot change. So then the question is, what are the items that can change that can lead you to have a $10,000 um, decrease in total expenses? And those would be like this here, order list,
Furniture. Mhm.
utilities, repairs, um, what is this? Cleaning and maintenance.
Mhm.
So all those items, if somehow you were able to reduce them, then in a way that obviously it's compliant and legal, that's between you and Fernando, right?
Mhm.
And by decreasing $10,000, then this number here will be 82. And so when I plug it in the other form and in the other formula, as long as the fixed items, like I keep on saying them, taxes, interest paid, insurance, as long as those items don't change, then we will achieve your goal of breaking even.
Mhm. Now, see, this is the part where I kind of need to be the bridge and have some understanding because your numbers, like if we can modify the numbers to make the DTI work, but then I don't know how that's going to affect me because if I understand, like I have the freedom to write off or not write off expenses, like you said, let's say line 19, there's probably some furniture there that it's convenient for me to expense it out, right? But what if I just don't? I can just delete those expenses, and then I know how to do that in QuickBooks, but they just won't show up. It's just delete them. I'm basically losing a write-off, but then I don't know how that's gonna affect the profit, and that's the part that I get is more of a tax thing that I need to understand. But I think on your end, I now understand that basically it's okay if I'm at zero. Zero is good. It just doesn't need to be. It needs to not look like a loss, right? But now on the other hand, though, like what if this is where the strategy in me comes in? What if we go on the other way? What if I do want to show profit? Like if that on the spreadsheet that you show me from Fannie Mae, Freddie Mac, instead of showing negative 16 or positive $16, like if it shows, let's say, a positive 1,000. Well, first of all, those 16 are monthly, right? Monthly figures. Okay, so then let's something more realistic. Let's say if it's $500 monthly, extra positive cash flow, does that give me more purchasing power?
Yes. So that leads us to the next step, right? So DTI, let me create a new there. Let's see. Okay, you're looking at my spreadsheet, right?
Yeah.
Okay, so DTI and let's see. What's your? I think your income is. Let's just say it's 3,000 a month,
Yeah.
right?
Hmm.
And so the DTI requirement will vary based on the type of loan and the program, and it will be anywhere from 43 up to 55. So if you're using a FHA loan, they can go up to 55. Conventional, it's going to be 45 if it's conservative, or 50 if it's aggressive lender. And if it's a high loan, like a high balance, 646,000 or higher, then they're probably gonna want you to have 43% DTI. So I don't want to confuse you, but just know that the requirement of the DTI will vary depending on what kind of what is your goal really?
Hmm.
Buy a $1 million home for yourself, or buy an investment property. But let's just say that we're going to use 50% because that's the easiest way.
Hmm.
I think that's the most reasonable to use, because that's also the most aggressive uh, with the best possible interest rate. So that means that, income is 3,000. Obligations or debt, we call them obligations.
Hmm.
In my world, lending, clients call them debt, right?
Hmm.
So the question is, what are your monthly payments? Like car loans, anything that shows on the credit report, credit cards, homes, all that. So let's say that your monthly payments, let's say you have I don't know, you have a cyber truck and it's $1,000, right? Now we already know that if you get your house to have a zero balance, that means according to this, even if you have a house under your credit and you have a cyber truck, uh, cyber truck, even though you have the house, because it's generating enough income, it doesn't affect you at all. It's like if you didn't have it. Now in this case, what is your DTI? So the DTI is basically calculated. You divide, 1,000.
Hmm. Can I stop you right there? Just had a
Sure.
brief question. So, um, for this example, we're gonna use the 50% DTI, right?
Yeah.
And then the house, you're speaking of Shalimar, right? As if it was spitting out zero liability, like zero loss, right? It's breaking even.
Got it.
Okay, gotcha.
Okay. So DTI, debt to income ratio. Okay. Let's see. I remember how to do this. So let's see 1,000. You divide that by 3,000. And your DTI, it's 33%, 33.3, right?
Okay.
Remember how I said that the aggressive DTI is 50%? So then that means that you have, the question is, how much more payment can you afford? How much more? much more. And since the math is simple, then I can tell you that you can gain a new loan that the payment is $500. And so if you have a new debt or a new loan that requires you to pay $500 a month, then if you do the math, 1,000 plus 500, it's 1,500, right? And we already know that that's half of 3,000. So you already are a 50% DTI.
Let me see if I understood this correctly. Let's say um, the banks only allow you to lend me if I have 50% DTI, right? Like if I were to have a if I were to have a car, which I don't right now, but let's say if I do buy a truck and the monthly payment is 1,000. Well, let me put it this way. So we have the 3,000, and then half of that would be 1,500, right? And then another 1,500. My question is it okay? Will I still, let's say if these are things like cars, credit card, and then on this side it's the loan for another house or whatever. Does it really matter what I have here if it's empty or not? They'll still lend me this?
No, it doesn't matter. That's why we're just building out the basics because now think about this. So we only address the Shalimar property, right? But now the reality is that you don't have a cyber truck, but now you're gonna have another house. So this is a problem. And so the payment is gonna be what did they tell you the payment is?
It was about 3,000, I think.
Let's just do 3,000, right? So think about that. So with 3,000, you already are 100% DTI. So if you apply for a for anything else, you're tapped out, you're maxed out. And this is where the other variables come into play. Like you can say, well, but that's not my house, that's my mom's home. Okay, but since it's a new debt, how do you prove that? Right? So you have to have 1 year worth of payments made by your mom. Let's say fast forward, it's April, let's say it's May 2023. We're having the same conversation May 2023, but for the last year, your mom has been making payments from her checking account or your dad or whoever. Not from your account, so you can submit those 12-month bank statements to the lender and say, hey, that's not my debt. I know it shows on my credit, and then awesome. So that doesn't count. So now you're back at your $3,000 income. But right now, you would they would consider that debt. So you're tapped out as far as any more income that you can get.
Yeah, I think you mentioned that, like if I wanted to do a HELOC or anything, it needed to be before the purchase. But I guess I would still, you did mention it. It's just that I think it was just better to grab it now because otherwise interest rates would have gone up and everything.
Yeah, they're way higher now. It's crazy. I mean, everyone's mad right now at the Fed because it's right now. If we were to do the same deal, it'd probably be 4.6 or maybe.
Oh wow! So it didn't bump up like another quarter, right? It went up a lot more than a quarter.
Yeah, they bumped it 25 basis points, and it's another deal. Like it's not so simple as maybe it's interpreted by consumers. It does sound like a quarter, but it's not a quarter. It's a cost. But every lender, the cost gets calculated by lenders differently, and then it's impacted by the market. So not only has it gone up, but they officially increased the cost. So therefore, if we were at 4.1 to 5, now we're like at 4.6, which is like a half a point, right? But anyway, that's a whole different conversation. But yeah, so yeah, that's how this works. So yes, so now once this San Pablo house goes through, then even if you were to increase your income at 5,000, you're still over 50%. Right? Because half of 5,000, it's 2,500, and the San Pablo home is 3,000. So you're still over 50%.
Now, question. Thank you, by the way. I think this is exactly what I was trying to understand, like the basics, so I can strategize forward. Um, the uh, the thing though is, so okay. If this house was 439, and then right now my DTI is compromised because it was my mom. It was all of us, right? Um,
Yeah.
but how would they have been okay if I hadn't been in the picture at 439, or did they still need?
I understand your question. But let me just refresh my thoughts on your file.
Because I think you said I was only contributing like $300 worth of purchasing power, but back then we were looking at, like, more expensive houses. Um, so this is where, like, if I understood things, I could make these questions quickly without having um, to call someone. It's all learning. I'm not complaining at all. This is really exciting, and we'll figure out a way. There's always things, but
Um, let me pull the file real quick. I'll ask that question by looking at it right now.
okay.
Okay, I remember now. The answer is no. I'll share my screen.
Hmm.
It's loading, but share. You see UWM, right?
Yeah,
Okay.
I love that company, man. They're awesome. Like, you can set up bi-weekly payments online. They don't give you any hassles. They,
Yeah, they're pretty good actually. I've been impressed with them, to be honest.
yeah.
So watch. So this is your property. This is all three of you, right? And look at where we're at with DTI. 48, only 98. Like 49%.
Hmm.
So we're only 1% off, and we're including all three incomes.
Hmm.
And we also had to pay your dad's loan, car loan. If
Hmm.
we might I can let's see. This application, you see my screen. Let's do this together.
Hmm.
So if let's say you ask me right now, hey, can I move my name? Let's try. This is what I'll have to do. I'll go to the application. I'll go to liabilities, and then I go, what debts are there on the three credit reports that we're using? So there's the Shalimar home. There's a loan that is being paid off. So this debt we're not even counting. But then there's this credit card. So this $77 credit card with a $21.65 balance needs to be paid off, zero. So that this payment disappears and doesn't affect the DTI. Ventura, this already is not even counting it because it has less than 5 payments, so it's already excluded, see right there here.
Hmm.
Then this is your mom's home. We cannot exclude that because the way we schedule, the way we formatted your loan, we could say, hey, never mind. I guess she is it's gonna be her home anyway. But then we have to change the contract, the lease contract. We have to resubmit it for review, and this is what happened with the Ordonez. That I think I know I'm joking. I know that if I quantify my time, then yeah, I lost money. But obviously my time has some value, right? But so anyway, my point is that we have to zero out every debt. This one, this one, this one. So they have to pay 21.65, 25.43, and 41. So that's about $5,000.
Hmm.
You pay those $5,000. Those monthly payments go away, which means that this DTI will decrease.
Mm.
47. Okay. And then we can remove you and say and see where we land, because you're if you were contributing $300, look at the monthly payments here. 77, 25, that's 102, that's 127.
Hmm.
So we might not even make it because even though you only added $300 to the picture,
Hmm.
if we eliminate these debts, it's still, we're not eliminating more than what you are contributing on a monthly basis.
Hmm. Hmm. And then, so just to be clear, that DTI that you showed me right there of 48%, that is where we're at now, right? But to qualify, were they asking us for like 45 or what?
50.
50? Oh, okay.
So now here's we can do it. That's not an issue at all. If I can ask, but here's I wanna this is what I learned with the ordonances, and this is what I want you to know now. So this file has been underwritten with three people, right?
Uh-huh.
And check this out. So one, two, three, and I have yet to do some homework because when I calculate the income, it's the exact same income. It hasn't changed because we've been using the same profile since like last October. When I sent it to Caliber, they calculated the income about $50 less than what I calculated. And so I think, okay, I'm pretty good. I'm a good underwriter. So it only added confidence. Well, guess what? When I submitted this same number, same everything to UWM, the income came higher. But that's because they're calculating the income differently, and primarily because right now we're not using P&L. I don't know if you know this, but I don't have to ask you this for P&L at all.
Mm.
Whereas when we did your milestone and when we were trying to do the first purchase with Caliber,
Hmm.
we had existing what I call overlays that we had to have a P&L, and the P&L became another variable in the income calculation.
Mm.
And for that reason, the income was such. But now, look at this. So according to the current underwriter, each of you are getting a $3,138
Worth of income?
worth of income,
Wow.
which is about $500 more than before. And I don't want to mess with that. I mean, I'm gonna figure it out because I want to know what changed. But I know what changed fundamentally,
Hmm.
but I haven't drilled out the details because this has benefited you and benefited me, and
Mhm.
and I go, okay, I'm just gonna run with them.
Yeah.
And they did this twice. Actually, if you can see my screen here,
Hmm.
they rerun it more than once, and I know that the income is accurate because they did it twice. Sometimes they just want to cover their bases, and so let me see my screen here. Uh, yeah, it kind of jumps to. I don't want to mess. But my point is that we can. I can definitely look deeper into removing your name. But I know for a fact that you guys will have to pay off those additional debts.
Hmm. Yeah, I think we were contemplating on because anyways, yeah, we don't want my dad to like be accumulating credit card debt, and we do have that money, so I think that would be great. Yeah, if if it's a possibility to remove me, so we can have um, a possibility, then that would be great. And then I also know that either way, we need to start making sure that the payments come out of my mom's account, right? Because I was gonna see for Airbnb, it would be easier for me since I'm already a super host. But I need to figure out if it's possible to either have two separate accounts, or she need bank accounts on the same profile, or if she would need her own profile. That way, when it comes to proving that she's paying for that house, it would um, we have a way of doing it.
Yeah, so I got you. The other thing I want you to know in advance now, which is something I learned, so this was to EWM as well. So this rate is already locked. Look at here. This is locked as of the 8th.
Hmm.
It's good through the 22nd. And
Nice.
this is the rate.
Nice.
Now, whenever a significant, let's call it material change happens in the application that affects the income and the rate that is significant. Not just we're not just off by a couple dollars.
Hmm.
Then this is what happened with Ordonez. Then this figure it's likely to change. Why? Because we're changing the parameters. Like
Hmm.
this is what the lender tells us. We approve you, we locked in your rates, but this is based on what you have given us. Now you're changing the deal on us.
Hmm.
Now we have to reassess what kind of interest rate that we give you. And if you agree, we'll go for it. If you don't, then we won't go for it. So what is worst case scenario? Let's say we remove you, but then the rate might change.
Mm.
And if it changes a tiny bit higher, maybe it's not a big deal. But if it changes a quarter or more,
Hmm.
because the rates are so close,
Yeah.
they might not even qualify. Here's why. Because now with higher rates, that means that your payment is going to be higher.
Hmm. The purchasing power goes down too. Yeah.
So that's the risk when changing something. And we're already, I guess if we were like at 43, 44, 45, we're like with your income included, right? Now the other question I have to ask you is, selling my property, let's see, I'm thinking, so they would ask me for 12 months bank statements, which I know you have,
Hmm.
but they're also gonna ask for, well, they already have your tax returns. Yeah, they're gonna ask for 12 months tax returns. Yeah, I can ask. This is what happens here. I basically go showing the technicalities of my job. I go and change, request a change. And these changes are very like, these are no light changes, right? This is if I wasn't the kind of loan officer that I am, or your friend, I'll be like, oh no, sorry, it's not possible. That's what I hear every day with my peer. Oh no, sorry, we can't do it. And,
It's like starting all over again, huh?
yeah,
Um.
and not only that, it really has a risk of killing the deal.
Mm.
So now you end up with no home, and I end up with no work.
No. Well, then
So that's why
let's.
most loan officers they don't even entertain the idea,
Yeah.
because it's already like we're already closed, right?
Hmm.
But I'm disclosing in advance.
Yeah. No. Well,
That
then don't worry. It doesn't have to be like that. I wasn't aware that it would be that labor intensive and everything. More than anything, I just need to like set the direction and intention of where I need to go. Like I know what I want, I just don't know what's the best way of getting there. But I definitely don't want to backtrack or yeah, I appreciate that you're my friend and you'd be willing to do that. But don't like I don't want you to lose money. I don't want you to like invest more time. Where I just need to understand is like what's the next step. So if I need to wait a year, fine. That's fine. I think you gave me that other strategy um, that works too. And always, I don't think we're gonna like we need to save up another 30, 40, 50,000 to get to that. So that gives. I just need to be clear that all the money needs to come out of my mom's account so that we could prove it in the future. Yeah.
And here's the other thing. Hold on. I'm going to okay, never mind. Okay, what was I gonna say? Oh yeah, so um, you guys right now it's called the DSCR, debt service coverage ratio loans.
Hmm.
They're super popular now because those loans are designed, but those are definitely investor loans. So this loan right here,
Hmm.
that's a primary purchase loan.
Hmm.
The rate is like 4.18. But if I show you a DSCR loan, I just do this together.
Hmm.
So DSCR means it's an investor loan, right? So we're gonna select the investment property. These loans don't require tax returns, but now you're gonna see the interest rate. So let's say same property, same. Let's go same. Let's do four. Let's do 400. Say 400,000. And let's do. I think we can do it at 90% LTV. So that means you need $40,000 in down payment. Number 7 6. Let's just do 6. Now 9235. That's San Bernardino County. Your score is 720. Sample code, yes. Purchase. Hey, we didn't get anything. Let's see. See what happened. Second one. Company. Okay, hold on. Oh yeah, right here. So this is a simple land. What's going on? Hold on. What am I missing? Hold on. Straight there. 720. Oh boy.
So are these the loans that they nickname like bank statement loans? The
Yeah. Yes, one up. Oh, 75%. I think this is asking for 75%. Okay, let me see. Yeah, I think this is 75%. Okay, so we're gonna start at 75%, and I'm gonna change it to 85. But this at 75% LTV on a $400,000 purchase, that means you need $100,000 of down payment. And then on this one, this is an investor loan. We actually don't need we don't need tax returns in any of that. But look at this is the rate.
mm-hmm.
It's actually the cheapest. This is your cost. These are the points. It will cost you 44.52. Let's say you wanted to get a lower rate, like 6.5, then it costs you 7,000.
Okay, so you're buying down the rate. Uh-huh.
Yeah, you buy down the rate, and so on 6.5, you pay 7,000 points. This is your PI payment.
Mm-hmm.
1896. But on this one again, you need 25%. 25% down. No tax returns, only bank statements.
Mm-hmm.
So now you're looking at, and if you wanted to pay down, usually it's more than like 3 points. Then we're at risk of the loan not being approved because we have a formula where we had to prove to like the Fed that this loan is good for you as an investor. Like you couldn't just tell me, hey Ricardo, I don't care, I'm gonna pay $20,000, give me a 4.8.
Mm-hmm.
That means it's gonna cost you 5 points, and it has to pass, if you will, a particular formula to justify that is good for you.
Hmm.
So usually that formula is around 3 points or less.
Hmm.
So that means that potentially if you wouldn't buy down points, it has to be around $9,000 or less
Hmm.
on this size loan that we're looking at, which is 400.
Hmm.
I mean, $300,000 loan with a $400,000 purchase.
Hmm.
Now, that's, yeah. So okay, okay. This is the bank statement loan.
Hmm.
So what I just said is this one that we're just getting right now. This is the DSCR loan,
Hmm.
which DSCR means we don't even ask you for bank statements.
Oh,
So
so it's different than the.
let's start over.
Uh-huh.
So we have two programs.
Mhm.
One is called the DSCR, and the other one is the bank statement.
Oh, okay,
The
okay.
DSCR, let's look at the least costly 4452. The rate is 7.25. This is the DSCR
Mhm.
of today. That means that we don't ask for tax returns. We don't ask for bank statements. What we do ask is for a 1007, which is an appraisal of rent schedule. So you have to pay. I don't know how much it costs. I think it's like same as an appraisal, three, four, $500. An appraiser goes to your property. You want to purchase. They'll do an evaluation and they'll say, hey, uh, how much in rents will a property like this generate? And they'll say, oh, this will generate $2,500 a month. Bingo. So then we were likely to do this though, because this one shows that the principal interest is 2,400 plus tax and insurance. As long as that is less than the monthly generated on long-term rental. I mean, you could generate 6,000 a month on Airbnb. That's a whole different issue. But that appraisal has to say that it has to be more than the PITI on this loan. And as long as that's the case, then we can give you this loan only loan with no tax returns, no bank statements.
Is there a number as to or a percentage as to how much more, or it could just be a dollar more? Like, what's the?
It's a 1-to-1 ratio. So let me do some quick math here. $400,000 purchase
Mhm.
times 1.25, those are the taxes. 416 in taxes plus how much in insurance did you say you pay on a house like that?
Like 80
$400,000
bucks,
home
85 per month.
plus $80. So that's 496. That's your escrow. That's tax and insurance. So let's add that to this 2046 plus 2046. So I'm getting 2542. So when we send this appraiser, they're gonna do comparables. They're gonna do what they do, and as long as they say, hey, this house will generate rental income of 2542, then this loan will go through.
Hmm. That's pretty cool. And then, is there any other fine print that could be aware of? Like, you know how you said the HELOC, like if the prices go down, they could pull it out. Is this one? Would this be locked at a fixed rate for 30 years, or is it?
Yeah,
Ah, okay,
yeah,
nice.
yeah. They said 30 years. It's a fixed loan. It's a obviously think about it. If the market is 4.5 and you're paying 7.25, that's why they're not asking, because you're then paying a premium on interest rate, so that they can insure themselves.
Hmm.
And should things go bad, then obviously they make an extra money up front, because knowing that the market is like 4.5, right?
Hmm.
So that's the benefit to them, but there's no specific like fine print or like any you know
Like balloon payment or anything. Like if anything
yeah.
changes.
No, definitely not balloon payment. This is look at this. This is a 30-year fix.
And what was the down payment on that? Did they give an option
This
like?
is 25. Let me check into 50 and see if we get something. At 90, we didn't get anything. I mean, at 10% down payment, we cannot get anything.
Hmm. What about 15?
Yeah, this is it. Let's see. At 15, um, no, we're not getting those. See this lane? This is what I missed earlier.
Uh-huh. That's the
Here
type.
tells you the program.
Hmm.
So this is traditional income. Let's say right now you want to buy an investment property,
Hmm.
then we're gonna ask you tax return. So you have to qualify on this.
Hmm.
So then let's see, usually there's a little trick here that they call it. So
Uh-huh.
we
So
go here.
technically, if I'm understanding this correctly, if the DSRs don't look at taxes and they don't look at income, all I really need to do is just find a property that cash flows that makes sense, right?
You got it.
Damn. So okay, I'll keep my eye on it because I know for sure a duplex would probably cash flow. Um, I guess I would have to see the numbers. They don't come off that often, but if I find one, then I don't have to wait another year.
Yeah, you know what? I've noticed even if you go to Zillow or any of those companies and we see on the top that says rent,
Hmm.
I've been noticing that they're not too far off. They may be a couple $100 off, but they're not gonna be off by 1,000.
Uh-huh.
That's another way that you can know right away know if the rent schedule will come out, what you're looking for.
Hmm. Wow, this is great. I didn't even know this thing existed. I thought I was confusing them with the bank statement loans, but this is even better in a sense because you don't even need the the bank statements either.
You don't, but you need more money down,
True.
and that's where a lot of people think about it. Some consumers, if they don't wanna, if they don't have, if they're having a hard time finding uh, 5% down, then this loan, and this is more like where you're at now
Hmm.
and going forward. But for new people that want to buy a home, this is not for them because
Hmm.
it requires 35% down and a higher rate. And if they don't know how to leverage that property to cash flow it, they're never going to do it, right?
True. So, and you said nothing came up at 20%, right? 25 was the starting down payment.
Yeah, let me rerun it. So first, let me make sure that I have the right info. This property, 25% down.
Can we try like four? Let's see, like maybe like 450.
Yeah, 450 purchase price.
Yeah.
Where am I? Are you see my screen?
Yes, the United Wholesale.
Okay. 450. Investment, single family residence, 740 FICO score, self-employed. So this be like 2,800
Mm-hmm.
PITI.
Mm-hmm. 23. Hmm. Damn, you know what? Actually, it's not even that bad. So that's principal, interest, taxes. Is the whole PITI or just principal and interest?
Remember how we? This is something that I think you should definitely learn. This is basic that I encourage you, and also the PITI, the PI, I can always get it for you, or I can also teach you how. But the tax and insurance throws a lot of people off.
Hmm.
But on new purchases, it's 1.25 of the purchase price.
Mhm.
All you have to do is 450.
Uh-huh.
450,000 times 4 times one and a quarter. That gives you 5,625 in monthly. I mean in annual. So monthly it's 468. So 468 plus $80 of insurance. Your escrow it's 548. You just run to 550. So 550 plus 2302. 550 plus 2302. 4302 plus 550. PITI would be 2852.
Mm-hmm. Hmm.
So now now we have to look at again the rents and make sure that. So I know it's exciting because I know that the Airbnb will generate that, but more than that. But the rent schedule is based on like traditional long-term rental income,
Mm-hmm.
and that's where you will have to do some pre-work because if it doesn't, let's say we're short, right?
Mm-hmm.
And then you pay for the appraisal, it comes out that it only generates 2,600, and your PITI is still A now you don't qualify.
Hmm. So it'll be about 112,000 for the deposit. Hmm. See, I guess this is where, like, if I had a property, maybe that's what I would use like a cash out refi for, to get an amount like that. But hmm. So okay, so these DSER loans, um, compared to a bank statement loan, the bank statement loan is going to be more forgiving on the down payment, right? You can get them for 10 or 15% down, or
Let's see. Let's see. I like your word choice. The more forgiving. Because DSCR though, they're not forgiving at all. When,
yeah, that's
when
for big
after
players.
yeah, exactly. Okay, we're getting bank statements at
20.
oh my God, right? Let me investments. Let's start up. So conventional, 80%. Wait, I think 80% also works in the DSCR. Probably wasn't giving me one. That's why I'm double checking my entries here. Even though you can write and it messes you up and then you miss quoting and that's not good. Hold on. So 80% max purchase return lease properties like 16 other returns. Maximum 70. Yeah, I think it lets you do 80% too. I'm checking the on different screen. I don't know if you can see that.
Hmm.
Okay, so let's. Okay, so conventional bank statement. Yes, yeah. You can do 20% down. Let's do 85. Okay, yeah, 80% is do you see my screen?
Yeah.
So check this out. When this means they what LTV, that means that you pay the difference, which is 15%.
Hmm.
A 15% when I run a pricing scenario, I don't get a bank statement loan, or I don't get the flex program, which is the DSCR program I was telling you about.
Hmm.
And if I go here and I look at that, it tells me the reasons. Uh, see, 80%.
Hmm. So 20.
So that means that we gotta be at least at 80. So 20% down.
Hmm. For bank statement, right?
20% down, you can get either a bank statement loan or a DSCR loan. The difference is that the bank statement loan is more forgiving in the interest rate. Not too much, but a little more forgiving.
Hmm.
The DSCR is a riskier type of loan, so the rate is gonna be a little higher.
Hmm.
If you have it.
So let's say on a bank statement loan, what are the rates looking like for that quantity? Are they more like at 6%, 5, or are still in the sevens?
So $450,000 purchase price, 20% down.
Oh, and another question. So I know you were showing me the PI, but the mortgage insurance, you wouldn't need it, right? Or do they still require a mortgage
No,
insurance? Okay,
no.
nice.
No, we were not even calculating that
Hmm.
in the requirement, but no, you don't need mortgage insurance.
Mm.
Okay. So what's just here? This is like the first statement. This is like the lowest. See, I think it already changed from the earlier to now.
Hmm.
Look how the cost is increased already.
Mm.
It was like 44 or something, right?
Uh-huh. Well, maybe because we were doing 400 before, and we bumped it up 50,000.
Yeah, that's definitely part of that. Just but they changed like that. Anyway, so
Huh.
yeah, so the ESCR loan is based on the rent schedule. The lowest cost it's 57 at 7.25, and for the bank statement it's 47 at 6.8. So it's about a quarter, like 3/8 of a percent cheaper on the bank statement loan.
Mm.
So it makes a difference. Here are the payments: 24.55 versus 23.64. So difference of what? That's 35, like 85, $90.
Hmm. About $100, yeah. Cool. Awesome. Yeah, it's okay. So this is good to know. Now I have more tools. Now I just have a basic question on DTI. So because we bought the house in San Pablo, the um, how does that affect our DTI? If like on the title it's gonna be Caleta Gloria Jorge, and the payment here it's about 3,000, right? Does that mean that my like let's say if we were is my if I wanted to purchase something else in the future, will this affect me my DTI by 1,000 each, or um,
It's all or nothing.
also basically it would be like it show as 3,000 on mine, like that.
Yeah, it'll show us 3,000 because remember we're still because they don't know It's all nothing because unless you have the bank's bank statements to show that somebody else is making payment,
Uh-huh.
it will automatically count it towards you. So the whole 3,000 goes for you,
Mm-hmm.
the whole 3,000 goes for her, and for your dad. So if your dad wants to buy a home,
Mm-hmm.
so he'll be responsible for that. Why? Because his name was on that loan.
Gotcha. Okay. Yeah, well then we'll just need to wait. And are you sure it's 1 year minimum or 6 months?
Yeah, it's 1 year. That's pretty standard. 1 year.
Mm-hmm.
Uh,
Perfect. Okay. Sounds good. And then for vehicles though, like let's say I do buy a vehicle like 6 months from now, you're saying that they use different calculations, right? Um they're not gonna look at that.
yeah, they're gonna, especially since you own a business,
Mm-hmm.
you can literally tell them, yeah, make $15,000 a month,
Uh-huh.
and they'll ask for your credit, they'll run your credit,
Mm-hmm.
they'll put 15,000, and you get the car.
Hmm. So it's like okay. Yeah. I didn't think of that. They were gonna be less strict. Okay. Well, Ricky, thank you so much, man. I really appreciate your time, brother. I really do. I know uh, accountants charge like $70 an hour and everything. You spent like 2 hours here with me, plus all the time on the phone. I really, really appreciate it. I'm gonna try and send you more business and recommend you with everybody I know. And but yeah, man, don't lose out. If I send you people and for whatever reason they're not a good fit, let me know and I'll try to understand more like what type of people you need and send more of those your
No,
way.
it's yeah, I got you. It's all good, it's the cost of doing business, right? It's like you, and I say that as friends, right? Because the reality is that that's the cost of doing business. Sometimes you get a, I don't know if it happens to you, where sometimes you get an account where you spend so much time, and then maybe they only order like a little something, and then okay, well, that's just the way business works, right? You don't want to have that happen every day, but
Mm-hmm.
I mean that's happened. The way I see it, it's part of business, right?
Mm-hmm.
But I learned a lot. In fact, Jeanette, she was very she wanted to talk to me. She's like, hey, can I do an informational interview? And I wanna, I'm thinking of a career change, and I'm thinking that, wow, aren't you like a professional? You're a counselor. I used to Riverside, and you have a master's degree. I didn't tell her that. I'm just speaking aloud my thoughts.
Mm-hmm.
But yet, she's realizing that she likes the whole loan officer. She was like, hey, out of all the loan officers that we spoke with, you're the one that, you spend your time, kind of what I'm doing with you, right?
Mm-hmm.
And I said, well, that's just my philosophy. I do this, whether it's loans or something else, that's just part of my makeup of who I am. But so we had a good hour conversation. I was telling her about the personal cost. She actually is considered being a loan officer
Mm-hmm.
herself. Whatever she makes, she can definitely make same or more as a loan officer. I know I exceeded my income last year from what I made at the bank.
Mm-hmm.
I made more last year, and this year it's gonna be the same. I know more. The market's a little more challenging, but
Mhm.
every day I learn something. At least every week I learn something new.
Mhm.
And so anytime I talk to somebody, whether it's an investor type of loan or something else, I can help anyone. So my point is, I learned a lot from her. Before that she was be a loan officer. I mean, they learned a lot from me, and they were very happy.
Mhm.
And she said that. She said jokingly, I don't know how joking she was. She was. So I told her my next step here for me is to build a team, because I build enough of a knowledge base where I can build a team now, and I know I enjoy building people up. I enjoy teaching. I enjoy encouraging people.
Mhm.
So that's my next step in this job. And she goes, oh, maybe I can be part of your team. And she's sharp.
Mhm.
You're sharp. So
Mhm.
it's like you're. I mean, you have to pass your licenses, which is not a big deal,
Mhm.
but it's an investment of time. It's not $5,000, I'll tell you that.
Mhm.
But my point is that if she wants to be a loan officer, she has to pass her licenses. She's gonna invest, I don't know, 6 months of time, spend a couple grand, $2,000, $3,000 maybe, and then she can do loans. And if she does loans and she wants to be part of my team, then I'll teach her, coach her, and then I'll probably make 5% of whatever she performs. And that could be $500 a month, or it could be 1,000 depending on how much she performs.
Hmm. Wow, that's awesome. Yeah, I think if you look at it short term, you could miss the opportunity and see it as a loss. But if you look zoom out and see long term, there's a lot of possibilities and a lot of like it'll definitely come back to you. It's just an investment. Yeah, like you said, it's an investment of time and yeah, yep.
Well,
Mhm.
well, hey, I'm gonna have other commitments in the house. I'm still in the office here. But yeah, let me know. I'm still curious myself when you deal. I know you said not to just leave it like this, but I'm still gonna. I mean, because the way I see it, right? If it really does work, then that helps you. That helps me. Why? Because that means that you can buy another property.
Uh-huh.
I mean, that's the way I see it, right?
Yeah.
Sooner than waiting a year.
Hmm.
So I'd rather do another loan now than next year.
Hmm.
But I also don't want to like risk you not getting your home and me not getting paid.
Yeah, no, for sure.
Really, when you think about it that way, it's like a win-win all around.
Hmm.
So I'm gonna do the math, and if it works, awesome. That means that there's more possibilities. And if it doesn't, then that means now we'll know that we're in a good position and we know what the game plan is for next year.
Awesome. Yeah, no, but seriously, bro, don't try to overextend yourself. You're already like going above and beyond. I really appreciate it. And yeah, it's progress over perfection. I don't need it to be like, I like taking risk, but I think this is putting you at risk and putting the loan at risk and everything. So I wouldn't want to like jeopardize any of that. So I appreciate your time, brother.
Okay, Gale, we'll be talking some more.
Thank you so much. Thanks. The next time you want to come out, sushi's on me, brother.
Yeah.
Nos vemos. Muchas gracias.
Okay. Me saludas a tu.
Claro que sí. She's super happy.
Okay.
Thank you. Take care. Bye.